Most people think the danger is that America will default. That is not the danger. The real danger is much quieter than default, much more respectable than default, and much more destructive to ordinary savers than default. It is this: the debt does not have to disappear for your purchasing power to disappear. Right now, people are passing around dramatic claims that the next Federal Reserve chair has some hidden blueprint to cancel America's debt. They use phrases like reset, debt wipeout, secret plan. Those phrases are sensational enough to travel fast, but they distract from the only question that matters. Not whether Washington can erase the debt on paper, whether it can reduce the burden of that debt by making every dollar in your pocket buy less. That is the game, and if you do not understand that game, you can spend the next 10 years feeling wealthier on a screen while becoming poorer. In the real world, I have spent my entire life studying capital allocation, incentives, and the ways human beings respond when the arithmetic turns ugly. When the numbers stop working, politicians do not suddenly become philosophers. They become improvisers. They look for the path that creates the least immediate pain for voters, the least visible pain for taxpayers, and the greatest room to postpone the reckoning. That path is almost never honest austerity. It is almost never large, clean tax reform. And it is almost never some heroic burst of growth large enough to outrun a debt machine already compounding faster than the economy. When a government is buried under obligations, the most politically convenient answer is usually not to destroy the debt. It is to dilute the currency. That is the first thing I want you to understand tonight. If you take nothing else from me, take this. The threat is not the headline number alone. The threat is the policy response that quietly transfers wealth from savers to asset owners. America's debt has climbed into territory that would have sounded absurd to earlier generations. The headline number is enormous. More important than the headline is the speed. The country is adding debt at a pace that makes ordinary budget discussions feel almost theatrical. And while most people stare at the principle, the interest bill is now large enough to compete with the biggest categories in the federal budget. That is when the problem changes character. A debt problem becomes a regime problem when the interest on yesterday's promises begins to crowd out today's choices. At that point, the country is no longer arguing about how to prosper. It is arguing about which constituency gets protected first, while the value of the money itself becomes the adjustment valve. People like to pretend there are many clean exits. There are not. You can raise taxes, but even aggressive taxation does not close a gap that large without changing behavior, slowing growth, and running straight into political revolt. You can cut spending, but the biggest spending blocks are precisely the ones that are hardest to touch. Retirement promises, healthcare promises, defense commitments, and the interest itself. Telling a country accustomed to benefits, security, and rollover financing that it will now accept less is not finance. It is a career-ending ritual. You can try to grow your way out, and growth helps, but growth is not a magic spell. If the liabilities are rising faster than the productive engine, growth becomes an argument used to delay arithmetic, not solve it. So the system turns toward the oldest trick in sovereign finance. I call it the quiet dilution mechanism. The debt stays on the books. The number may even keep rising. But the real burden is reduced because the unit used to measure it becomes weaker. This is how a nation can claim stability while a saver finances the repair bill without ever receiving an invoice. After the Second World War, the United States came out of the conflict with debt that looked overwhelming relative to the economy. Yet, over the following decades, that burden fell sharply. Many people later told themselves a comforting story about discipline, growth, and natural healing. The truth was more interesting and more useful. Yes, there were periods of restraint. Yes, there was growth. But there was also a regime in which interest rates were held below inflation for long stretches. Financial institutions were pushed toward government paper, and savers earned returns that looked nominally acceptable while losing ground in real terms. That is financial repression. It sounds technical, but the logic is simple enough to explain at a kitchen table. If I owe you $100 and, over time, I engineer a world in which each dollar buys far less, I may still hand you $100 back. I have honored the contract in nominal terms, but I have not honored it in purchasing power terms. The contract survives, the value does not. That gap between nominal promise and real value is where governments hide, and it is where savers get injured. I want to name the second mechanism clearly, because once you see it, you will start recognizing it everywhere. I call it the captive capital mechanism. When a country needs to finance itself cheaply for a long time, it cannot rely only on voluntary enthusiasm. It helps if banks, insurers, pension systems, and regulated institutions are naturally pulled, nudged, or effectively forced toward holding government debt or financing structures linked to it. Sometimes that happens through law, sometimes through capital rules, sometimes through the design of the system itself. The packaging changes. The principle does not. You do not need a villain in a smoky room to make this happen. You only need a structure in which the incentives of the state, the central bank, and the financial system begin to align around one mission. Keep funding costs manageable, keep confidence alive, and keep the public from realizing that the burden is being socialized through the currency. That is why I always tell people to study incentives before slogans. The public hears relief. The institutions here yield control, balance sheet management, and asset support. The saver hears nothing. Then one day he notices his cash buys less, his safe income lags inflation, and every productive asset he delayed buying has moved farther away. That is not bad luck. That is the transfer. Most ordinary investors make one catastrophic mistake when they hear a story like this. They immediately search for one hero, one villain, one date, one policy meeting, one chairman, one rate cut, one announcement that will supposedly flip the whole system overnight. That is not how these things usually work. A debt regime does not change with a trumpet blast. It changes through a slow drift in incentives, a little more tolerance for inflation here, a little more political pressure for lower rates there, a little more institutional demand for government-linked assets, a little more public acceptance that nominal gains are real gains, a little more distance between the way wealth is reported and the way wealth is lived. By the time the average person realizes the rules changed, the repricing has already happened. That is why waiting for certainty is so expensive. I have seen this pattern in markets again and again. The public wants a clear event. Professionals watch the direction of travel. The public asks, has it happened yet? Intelligent capital asks, what regime is being built under my feet? That is the real question here. Not whether one future Fed chair has a secret button. Whether the entire system now has a strong incentive to prefer manageable real rates and gradual wealth transfer over visible pain. I believe the answer to that question is yes. And if that answer is yes, you must change the way you define safety. This is where most people fail the test. They look at cash and call it safety. They look at a fixed coupon and call it safety. They look at a salary that rises slower than living costs and call it safety. That is not safety in a repression regime. That is stillness. And stillness can be lethal when the measuring stick itself is shrinking. Safety is not a stable statement balance. Safety is ownership of productive claims that can adapt when money weakens. I call this the asset transfer mechanism. When governments choose dilution over default, the debt burden does not vanish. It is transferred. The people holding cash, long-duration fixed claims, and slowly adjusting income streams absorb the pain. The people owning scarce, productive, or repricing assets have a chance to outrun it. Notice the word I used, chance, not guarantee. This is where amateurs often injure themselves. They hear that cash is vulnerable, so they rush into whatever has gone up the most. They hear the system favors asset owners, so they turn concentration into a religion. They put too much in one trade, one commodity, one theme, one piece of technology, one story about the future. That is not intelligent positioning. That is panic wearing a suit. The right response to a repression regime is not frenzy. It is protocol. You need businesses with real pricing power. You need ownership interests that can adjust with nominal growth. You need some exposure to scarce real assets. You need liquidity, but not so much idle liquidity, that inflation eats you alive. You need to respect valuation, because even a good asset can become a terrible investment if purchased at a stupid price. And above all, you need diversification broad enough to survive your own overconfidence. People often misunderstand my investing philosophy. They think it is about finding wonderful companies and then forgetting the world exists. That is only part of it. The deeper principle is understanding which economic structures can absorb pressure and pass it through, and which structures simply absorb pressure until they crack. In an environment where the currency is being managed in favor of debt sustainability, the strongest enterprises are not merely profitable. They are adaptive. They can raise prices without destroying demand. They can protect margins. They can finance themselves without begging the market for mercy. They can remain useful when consumers feel poorer. Those businesses become islands of resilience in a sea of monetary compromise. Now, let me show you the trap that catches intelligent people. They say, I understand the thesis. The debt is too large. The government will prefer inflation. Therefore, I will just wait for confirmation. Confirmation usually arrives after repricing. The market is a discounting machine. It moves on direction, not on press releases. If you wait until everyone agrees that purchasing power is being sacrificed, then the owners of productive assets have already been paid for understanding it early. That is why information alone is not enough. You need an operating system. I want to give you mine in a form simple enough to remember. First, measure your wealth in units of purchasing power, not in nominal dollars. Do not ask only whether your account is up. Ask what your money can buy versus a year ago: housing, energy, food, healthcare, education, productive assets, and quality businesses. A portfolio that rises 5% in a world where the things you need rise 8% is not winning. It is reporting a polite loss. Second, separate liquidity from long-term defense. You need some cash. Cash buys time. Time prevents forced selling. Forced selling is one of the great destroyers of wealth. But cash beyond your genuine strategic need should be treated with suspicion in a dilution regime. It is not a nest egg. It is melting optionality. Third, build around productive ownership. That means strong businesses, sensible equity exposure, and a bias toward assets that participate in nominal expansion rather than simply endure it. I am not telling you to speculate. I am telling you to stop mistaking inactivity for prudence. Fourth, refuse concentration as a substitute for conviction. The repression trade is not permission to become careless. Gold can be overowned. Real estate can be mispriced. Stocks can be euphoric. Fashionable sectors can become graveyards. The goal is not to predict a single winner. The goal is to ensure that your capital is not trapped on the side of the transfer that gets quietly taxed. Fifth, keep your internal scorecard real. If your salary rises 3% while your cost of living rises 6%, you are not standing still. You are moving backward. If your bank gives you a yield that looks pleasant while inflation runs hotter, you are not earning. You are surrendering elegantly. And if your portfolio is built for a world of stable money while the sovereign needs easier money, you are making a regime error, not merely an allocation error. That internal scorecard matters because financial repression works best on people who evaluate themselves in nominal terms. The public does not rebel against dilution when the numbers in the account still go up. They rebel only when daily life becomes unmistakably smaller. By then, the transfer is old news. There is another part of this story that deserves honesty. Many people online take a complicated institutional system and flatten it into a cartoon. They say the central bank is secretly run by a handful of private interests, or that one chair alone will dictate the outcome, or that one date on a calendar marks the beginning of a new era. Reality is less theatrical and more important. The central bank sits inside a system of public mandates, market expectations, bank incentives, fiscal pressures, and political realities. That system does not need perfect coordination to lean in a certain direction. It only needs enough pressure from enough corners for the same broad outcome to become the least resisted path. That is how history often moves. Not by master plans, by converging incentives. And converging incentives are more reliable than speeches. I have no interest in selling you fear for entertainment. Fear is cheap. What matters is whether you can extract a durable principle from the noise. Here is the durable principle. When a country carries immense debt, cannot politically stomach honest adjustment, and depends on a financial system capable of absorbing government obligations, the saver should assume that preservation of nominal stability may come at the expense of real purchasing power. Once you accept that, the rest of your decisions become clearer. You stop asking whether the debt will be canceled. You start asking whether your own capital is positioned on the wrong side of a long transfer. You stop staring at one chairman. You start studying the regime. You stop worshiping cash because it does not move. You start respecting assets that can survive the motion. You stop confusing a higher account balance with a stronger financial life. You start measuring life in ownership, adaptability, and purchasing power. That is the point where you stop being a spectator. And this is the final test I want to leave with you. If the next decade gives you exactly what heavily indebted governments have given the world before, lower real rates, periodic inflation tolerance, pressure on savers, and support for asset values, would your current balance sheet quietly benefit from that, quietly survive it, or quietly get eaten by it? Most people do not know the answer. That ignorance is expensive. Tonight, write down every major category of your wealth: cash, bonds, equities, real estate, private business interests, precious metals, or other real assets. Then ask one hard question about each line. If the dollar loses purchasing power for 10 years while policymakers keep the system liquid and the debt serviceable, does this holding adjust, endure, or deteriorate? Do not look for perfect answers. Look for honest ones, because the investors who come through these periods strongest are rarely the loudest or the most ideological. They are the ones who understand that the game changed before the scoreboard admitted it, and they repositioned before the transfer was obvious. That is how intelligent capital behaves. It does not wait for permission. It reads the incentives, names the mechanism, builds the protocol, and acts while the crowd is still arguing about the headline, and in dollars that no longer mean what they used to mean. And that is why this moment matters, not because a secret exists, because the mechanism does, and because once you understand the mechanism, you no longer have the excuse of innocence.